Andrew Balls, you are Chief Investment Officer Global at Pimco. When you have a look at the discussions about Greece, if Greece left the eurozone, what would that mean for the rest of the other countries in the European zone, especially for problematic countries like Italy or Spain?
So just first, we don't expect Greece to leave the eurozone. We expect a deal, and it's going to be an ongoing challenge, the Greece adjustment. But our expectations are for a deal now. But the risks, if Greece did exit the eurozone, the risk is that you demonstrate that rather than being a real common currency, it's actually a fixed but adjustable exchange rate peg. And then in the medium term, there is the risk of markets pricing in just more risk premium, currency risk premium. So that's the medium term challenge. And the immediate challenge would just be market instability, a big surprise, broad sell-off in terms of risk assets. In both cases, we think it's likely that the ECB would act aggressively, using its balance sheet, using quantitative easing to address the short-term issue and the medium-term issue. And over time, it's likely that you would see potentially greater deepening of the relationship within the Eurozone, stronger banking union, for example, if you did have this increased threat. But as I said, our expectation is that Greece will come to a deal, and while it will be bumpy, that Greece remains in the Eurozone.
The euro has decreased a fair amount following the QE program of the ECB. What do you think, what's the development of the euro in the next, let's say, 1 or 2 years?
So you had a big adjustment the past 12 months and helped by QE, and the pace of that adjustment became a bit of a problem for the Federal Reserve, so we slowed down recently. Our expectation is we'll get a grind higher for the US dollar, modest depreciation for the euro over time. That would be enhanced as we get closer to the start of Federal Reserve rate hike cycles. Also, in terms of the Fed's concerns, a modest depreciation of the dollar is not a big concern. It was the rapid movement we saw earlier this year at a time of weaker US growth that was a concern. And on the European side, part of the logic of QE is to depreciate the euro currency. Part of the reason for a somewhat better European growth outlook reflects the currency. So I think the ECB would be keen to have the ongoing modest depreciation in terms of the euro exchange rate.
A lot of depends on US rate hikes this year or the following year. Some people say that the US Fed, the US Central Bank, will raise rates only in the beginning of next year instead of, a lot of people expect this year. What's your opinion on that?
We think the Fed will most likely raise rates in September, if not starting in December. They have invested a lot in preparing the ground for a move this year. The data we think is going to validate that. There were some reasons, statistical, weather, port strikes for weakness in Q1, but we think that's going to be shown to be just a blip, not a real slowdown. The underlying labour market data is quite strong. And so our expectation is the Federal Reserve would start in September, move every other meeting, so September, then December. And our best guess is gradually move up towards about 2%. There is a possibility if growth is slower over time that they would just stop. They've been very clear that they don't want to have a preordained path, that they're going to be relatively flexible. Their expectation as well is for a lower terminal rate than historical. So that's our best guess, and that's how we're positioned.
Markets were almost panicking when the Fed only announced that they will stop the QE. The big question is now, how will markets react when actually the Fed will raise rates?
So it was a big surprise to the Fed that the tapering announcement on QE in May 2013 had such a big impact. So part of the reason they're trying to be so careful and clear in their communications now is to avoid a repeat of that. But even so, we think it's likely that you will see a rise in volatility at about the time the Fed is signaling clearly that interest rate hikes are imminent. There's probably still quite a lot of market participants who don't expect the Fed to hike rates this year or maybe next year either. So there is the potential for volatility. And so we're positioned expecting a rise in volatility prompted by the Fed, but probably not a repeat of the extent of the volatility we saw in the 2013 taper tantrum, because the Fed will have done a much better job in terms of preparing the ground.
We have to live with lower interest rates in the next couple of years than we used to have, let's say, 10, 20 years ago. Some central banks like the ECB or even the Swiss National Bank imposed negative interest rates on their account to fend off inflow of money. What's your opinion on the effects of that negative interest rates?
So starting with the European case, the ECB has gone modestly negative. I think it's less powerful than QE, but it's been important in anchoring the front end of the curve. So during this period of volatility, the front end has been more anchored, and I think it's contributed to the weaker euro that we've seen over the past months. The Swiss case is a different version of the attempt to prevent too much appreciation on the part of the Swiss franc. The practical implication is I think there's good investment vehicles that a firm like Pimco or other global investment firms can offer to Swiss-based investors, which are going to provide better returns than those available in local cash type investments. It's a feature of the investment environment that we have to protect against negative yields across all the portfolios we manage. We'll work very hard to make sure we don't have negative yields in the portfolio.
Final question: as an investor, how should your private asset allocation should be in the next 3 to 5 years?
So starting with the overall asset allocation, we think equities look attractive, and in our asset allocation portfolios, emerging market equities look attractive as well, as part of the overall investment strategy. In fixed income specifically, we think that income generating strategies make a lot of sense in a world where we think there's going to be a gradual drift up in overall interest rates. We think a focus on income is quite attractive. And we'd also say that it's an environment where active management is going to be important. In a lower return environment, if we can reliably generate alpha, that's going to be a larger part of the overall total return. So you can do this in traditional fixed income vehicles, in funds. We've also seen growth at Pimco in alternatives, in private equity type strategies, and we think that as well can be a good complementary part of the overall asset allocation.
Andrew, thanks so much for your time.